Welcome to Saxo Bank's morning call on Wednesday, the 1st of May, and we have an exciting session, I think, ahead of us with FOMC and very strong equity markets again, driven by sentiment carried higher by Apple's results after the market close. But we'll get back to that. If we start with FOMC tonight, Trump certainly started the show with some interesting tweets last night. Ole, what's going on here?
Well, just before we turn to Sten's take on today's outcome, just take a look at the chart here or the table. You can see that we had this two tweets out yesterday. Say, well, what China can do, I can do better. So it would be nice to see a 1% rate cut, and we'll see the economy shoot up like a rocket. And a little bit of quantitative easing would be nice as well. So that's obviously setting the stage for today's FOMC meeting. But as you can see on the table below, the market is still looking for a rate cut this year. 41% currently pointing towards that. You can argue with the accuracy of the numbers, but at least it's pointing towards cuts. But Sten, I don't think a cut is in the cards anytime soon.
At least if it does happen, it will be a major loss for the Federal Reserve because, of course, they will be seen to give in to the pressure from Trump. But I also think what we need to notice is that overnight there seems to be struck a deal between the Democrats and the Trump administration to do infrastructure investment to the tune of $2 trillion, which again, of course, is not exactly creating a need for lower interest rates. There has been, and in all our colleagues around the world is talking very much about the fact that there is a need for a lower interest rate, if not only because the short-term end of the US yield curve is very, very peculiar in the sense that Fed funds actually trades higher than the deposit rate at which banks can deposit it, which should indicate that there's a shortage of capital in a system full of capital. I think it's very technical. I think it will go away. It has a lot to do with the tax payment that just happened in the US. But overall, I think the Federal Reserve will be plain sailing for now. Inflation, which is, and the deflationary talk that a lot of people want to talk about, is not there. If you look at 5 years, it's trading at 230 basis points. So I think all in all, there's huge expectation for a boost or some sort of a give-in from the Federal Reserve. I see them standing by.
Yep. So a dovish signal as much as possible, or what?
No, a neutral signal. Neutral because the market is expecting a very dovish signal and concerns about the downside in inflation. Of course, we saw the GDP, the PDP deflator, which of course is the true definition of inflation in an economy, because that's the very number you use to go from running prices to constant prices. Yeah. So in effect, and that was extremely low. But I think, I have to say this with a smile, I think that number was managed downwards because, of course, the lower the deflator number you have, the higher the GDP number you get. So I think there will be a reversal of that number going forward. But in terms of the forward-looking inflationary aspect, it's on a upward trajectory. We think that in 2020 there's going to be supply constraints. And of course, what really drives inflation in the economy is oil. And oil, of course, trades towards the higher end of the range. And the year-over-year change in oil prices translates directly to the inflationary pressure.
Yep. Yeah. Well, we'll get back to oil. Yep. When we talk monetary policy, gold is typically one of the key assets to follow. And there's a lot of moving wheels here. You have the lower than expected inflation. We have the dollar still strong, but weakening a little bit in the last couple of days against the euro and other currencies. Well, and central banks across the board are in dovish mode or easing compared to just 6 months ago. So take us through the gold and how it's
just
responding.
A brief comment on the chart. You can see we've had a bit of a recovery over the past week. Last week was actually quite a strong week for gold because we had a week where record highs were seen in stocks. We had the dollar moving higher, and we finished the week with a very strong GDP number, which can be a certain extent down to one-offs. But overall, we're holding above these support levels. But moving into the FOMC meeting today, there might just be a little bit of nervousness emerging once again, and as you mentioned, stocks continue to move higher, so we're simply just missing the spark right now. I think the only thing we can conclude so far is that there is some underlying demand starting to come in at these lower levels, but it's not enough for this stage to really set off a move to the higher. For that to happen, stocks lower, VIX higher.
All right. which could happen. I'll argue that case in a few slides. But overnight, we also had export numbers out from South Korea, and the most important subcomponent of that time series is the exports to China. And if you look at the chart here, we're still in negative territory. Exports from South Korea to China is down almost 5%, sorry, year on year. It has improved somewhat over the past couple of months, but economic activity is still low. The big question here, I think, Stine, that goes to you. As we've talked about in the past couple of months, we're seeing stabilization, but the question is whether we will see an improvement and actually swing into actual growth in export numbers here. I mean, what's your take? Are we just stabilizing at very low activity levels, or can we maybe carry on?
I don't think we're even stabilizing, but we call it the macro theme right now is false stabilization. Which followed, of course, the great policy panic. So now the numbers will improve because you have a transitory impact from lowering the price of money. And that's clearly also what you see in the case of South Korea. But I think you're absolutely right also to point out, it's a little bit whether you're going to relegate it by 20 points or you're going to relegate it by 10 points by the end of the season right now. We need to see the move into forward. And I know the next slide that's coming up, you already see that China has been unable to sustain the improvement in its PMI.
Yeah, we have it right there. That's the table. So the China PMI figure there, 50.1. That was a big disappointment that set off some risk-off sentiment in markets. But it's odd enough, as we talked about, Stine, before we went into the studio, you have Australia. It seems like a very volatile time series. I don't think we should read that much into it.
But Australia is also China, so there will be 1 month, 2 months lagged to the China improvement that you saw last time.
Yeah. But as you can see here, overall PMIs are still weaker. Germany, in particular, with 44.5, with their deep links to China, they still confirm, I think, the very low economic activity overall. France, and France is also still weak, right, in the Eurozone as a whole.
Yeah, and note all the numbers. The average is 49.3, which means we're in a contraction economy.
Yeah.
So, exactly. At a time where everybody in the world is starting to talk about infrastructure, as we have also done, that the MMT, the whole, central bank policy cannot do this job. Now the politicians are trying to step up on the fiscal side. And I think these numbers confirm that one, that central bank policy doesn't work, and two, that the politician will need to be seen to do something about these PMIs.
Yeah. All right, and talking about weak PMI figures in Europe, I just want to give you an update on what's going on in the earnings season, because Europe is kicking into gear now with a lot of European earnings coming out. And if you look at this chart, it's rather depressing. So these are the year-on-year changes in operating profits for European companies, the 600 largest. And as you can see here, we just continue to trend lower. And it's the same picture we have in the US, but there we're still in positive territory. But in Europe we're trending down, and it's the same goes for sales growth. So not very much of excitement to read into these earnings releases from Europe. But these are preliminary figures. We will get much more clarity on where actually we are in Europe next week. So I'll obviously give an update on that. And moving to a little bit different subject, oil, which is still extremely important, as Stine mentioned, both for inflation, but also as sort of an indicator of confidence in the economy, but also supply constraints.
Absolutely, and we've had this very, very strong rally so far this year. I think if we look at the chart here, we can see that the market, at least for now, the market rally has paused. If we did that on the weekly chart, it looked the weekly bar last week was pretty ugly. That has attracted some technical selling, but still the fundamentals are still very supportive. The technicals maybe not so, just at least here in the short term. The market today is really just focusing on the stock report from the US this afternoon. Yesterday, the API reported quite a bigger build than was expected. So if that is repeated this afternoon, that potentially could just add a little bit of pressure. But I think for now, 70 in Brent and 60 in WTI probably pretty solid support at this stage. While we still don't know exactly what's going to happen with the production cut deal with Saudi Arabia versus US and Saudi Arabia.
What about Venezuela?
And Venezuela as well. We saw this attempt yesterday to overthrow, which failed. So there's a lot of uncertainty still, which I think is still creating a relatively lonely space for a potential seller there. So we got some support. We potentially could drop a couple of dollars, but I think that's when the support will re-emerge.
All right, and swinging it back to US equities, we're now at the first day of a new month, so we had the final numbers for last month's April, and as you can see here, The valuation of US equities has really bounced back forcefully from those lows in December, and as you can see with the red dot here, we're actually moving back into expensive territory again. And given the rally and the themes that you've talked about, Sten, and we touched upon this this week together with John Hardy, I think it is time to take advantage of the low implied volatilities and either hedge or take some profits off the book, because I think we begin to run out of steam as we move into the summer months. Clearly, US equities have discounted a massive improvement in economic data, and I don't think we're seeing the same sharp rebound in economic activity as we've seen in equities. So I think it's time to take it a little bit more easy here.
And I think also we just should just remember as well, we have a record short in the VIX. It's even bigger now than it was when we had the blowout in the early 2018. So so there is this added risk component to keep an eye on as well.
Exactly, and I think my interpretation of why we have that massive short positioning or net positioning to the short in VIX is clearly driven by hope in the Fed to just compress volatility for the rest of the year. But I think I don't know how you read it, but I think it's a very dangerous trade.
It's certainly a dangerous trade, but I also think it has to do with the China-US trade deal, which is a never-ending story in terms of the termination of the talks and a declaration of victory by both the Chinese and the US. And I think the CNY dollar relationship has been, very often a gauge for what kind of volatility we have. So we have a compression of volatility across the curve, which sort of fits with the global policy response stabilization phase we're in. But as at least our conclusion, it remains the same, that when you have PMIs, forward-looking indicators trading below, if you look at the national activity levels in the US, Chicago, it's negative and by a big magnitude. I think the market is discounting too much. And as you come into this gap between perception and reality of the economic situation, the ability of companies to translate that into earnings will come back to haunt them. Because as we've seen with the chip sector, the CEOs, the CFOs of the chip sector remains very bullish. But when we look at the actual shipment that goes on, is very, very small and falling. I don't know what Apple said in terms of units sold yesterday, but I presume it wasn't good news.
No, it wasn't good news. And it's interesting you say with the Chicago National Activity Index that that's a better measure of GDP, and Trump is taking the 3.2% GDP growth at face value, where almost most of all the economists I've seen acknowledges that the real underlying GDP numbers is much weaker in the US because there was some distortions over the trade.
The current account contribution was over 1%, and that was a false one, because normally the current account will be a drag on the growth, because a lot of the companies were storing ahead of this trade deal at the end of the quarter. Expected deadline. So yeah, it was a very distorted number. Plus that you had the deflator being extremely low, 0.8%.
Exactly. So probably the underlying trend growth in the US probably below 2% at this point. I suspect.
I think ever since the great financial crisis, US real growth has been 2%.
Yeah. But coming back to what you said about Apple, Apple reported the fiscal year 19 Q2 results yesterday, and the share price was up 5% in aftermarket trading. The results were better than expected, and the outlook was also quite strong. But I have sort of marked in red sort of the real story here. So Greater China, weaker, and I suspect that trend will continue. Apple, I think, is increasingly being locked out of the Chinese market, both not on purpose, but it's a lot of it is their own fault. They're setting the price too high, and Huawei is just producing almost maybe even better phone at a better price. So I think Apple increasingly will lose revenue out of China. iPhones I've marked as well massively down. So they're trying to offset it with their accessory and services sales, and that's going okay. That's the lower table there, but it's not enough to offset it completely. But keep in mind that expectations going into the earnings release was still a little bit muted given Apple's very disappointing outlook back in January. But for now, it seems like things are holding together, and I would not be surprised to see Apple have a positive impact on Nasdaq. But as you and I talked about, Sten, going into the studio, the Nasdaq is actually looking like it's some fatigue. I mean, I think for the last 5 sessions, it has sort of banged towards these resistance levels, and not really much is happening. So
it's very difficult to fight the momentum of the bullish market, of course, but technically it's extended. So at a bare minimum, you should see a correction inside this trend upwards. I think it's difficult to call a significant down move in Nasdaq as long as the U.S. remains the only harbor for capital. As you just alluded to and showed that Europe is not doing well. China, people are extremely skeptical. If there's one takeaway from the Gateway to China events we had around the world, it is that people are fascinated by the story of China, but very few people are invested. Yeah. So, where does that leave? People have excess capital. There are pension funds every day that needs to invest money. There are long-only managers that remain benchmarking, and the momentum just keep grinding the market higher and volatility lower. But technically, certainly, we could see a correction inside this bull market.
All right. Going through the two calendars, starting with earnings, is not a particularly interesting earnings session. So I think if you look at the table here, it's tomorrow, which is the most interesting. Watch Volkswagen and DuPont as sort of guidance for where we're headed in terms of macro. I don't put a lot of faith into companies' ability to forecast where their businesses are going. But it's always interesting to watch the cyclical companies, and Volkswagen and DuPont certainly are one of the two most cyclicals left in this earnings week. And on Friday we have HSBC and Novo Nordisk. The table below is just showing you the sales surprise is actually negative now for US companies, and importantly, both industrials and the materials sector are the two weakest components, offset by strength in healthcare, which is not a big surprise, and information technology.
But healthcare trades relatively cheap though. Healthcare has been underperforming, right?
Yeah, but I think that's an anticipation of the Trump attack, which is coming as soon as China is out of the way. He really wants to nail that one. The macro calendar. It's there's ISM manufacturing for April. That's probably the big show today. ADP as a lead-in to the non-farm on Friday, and then we have that big one, the FOMC rate decision. We don't expect anything on the rate decisions. It might be the color in the wordings and everything that's said between the lines.
I think the look for the inflation text, whether they are getting nervous about the downside to inflation.
All right. Thank you so much. Thanks for joining us, Sten Jacobsen, and thank you for joining our morning call. We'll be back at the same time and place tomorrow. Thanks.